Hello, welcome to SilverOak's quarterly webinar. My name is Shannon King, and I am the President, Partner, and Chief Compliance Officer of SilverOak. With me today, as usual, is Jonathan Charlo, one of our partners and also our lead analyst. In addition, joining us today is Chris Link, one of our senior directors. Today's structure will be very similar to past webinars, but for obvious reasons, I should note that we are all three connected into the session in separate locations rather than in the same room. So this structure will be a little bit different for us as presenters, just to give everybody there in the audience a little bit of a heads up on that. The webinar is scheduled to last 50 to 60 minutes. A copy of the materials will be posted as usual to the SilverOak website afterwards. If you have any questions throughout the webinar, we encourage you to contact your SilverOak advisor after the session ends. And if you're not working with a SilverOak advisor, feel free to contact me directly at 952-896-5701. And of course, I want to thank Jonathan and John and the rest of the SilverOak team for making today's webinar possible, both from a materials perspective, but also from the technology perspective. And also note that we are holding this webinar a week, maybe even a week and a half or so earlier than we normally would, just to try and get the information out as quickly as possible, given all of the circumstances over the last couple of weeks. And for compliance reasons, I do need to note that we will be discussing the overall markets and economy during this webinar. And in doing so, we will be providing our interpretations and perspectives. You should not rely upon this information as fact when making any investment decisions. We will also not be discussing SilverOak portfolio performance specifically, as each of our client portfolios are customized. However, all of our clients should have received their performance reports over the last week or two. And if you have any specific questions with regards to those reports, I encourage you to reach out to your SilverOak advisor if they've not already contacted you. And as Chief Compliance Officer, I guess my last note is to indicate past performance is no guarantee of future success. So with that, let's take a look at today's agenda. And as I mentioned, the structure is going to be very similar to prior webinars, where we'll start looking at the economic data for the quarter. We'll transition into a discussion around the market data for the quarter. Then we'll go into SilverOak's outlook as we look past this quarter into the next quarter or two. We're also going to discuss past pandemics and how they have impacted or maybe not impacted the markets, and at the same time, how we are making history as we speak. And then Chris is going to spend 10 or 15 minutes with us going through the recently passed CARES Act. And he's going to touch on some of the major provisions of the CARES Act that may be impacting you and several of our other clients. And of course, throughout today's webinar, we're going to try and answer questions that we received prior to the webinar. And at the end of today's session, we're going to ask for additional questions moving forward and for future webinars to address. So let's start with the economy. And Jonathan, I think this slide pretty much says it all.
Absolutely. Obviously, everyone knows that a lot of things have changed in the last couple of months, and it's really impacted the economy.
Yeah, and so with that, let's start, Jonathan, with just a brief discussion on the market dashboard, which is made up of four major components. And I don't think it's going to be a surprise to anyone attending today's session that pretty much all of these components have been downgraded since our last discussion in January.
Absolutely. So here we're looking at the economy. Obviously, the economy was doing well until it wasn't. And as a result, March was so negative that it actually causes the first quarter to be negative.
And we're going to see that too with the credit markets where, I mean, honestly, if we had measured this as of the end of February, we would probably still be in the gray, which by the way, my apologies for everybody attending, but as you look at this chart, it may be self-apparent, but if the quarter is colored in green, that's positive. If it's colored in a gray, it's more neutral. And of course, as Jonathan just alluded to, red is negative. And we saw credit markets shift really entirely in the month of March from neutral to negative. Now, one thing that we didn't see shift, Jonathan, is valuations. But I suspect, and you can correct me if I'm wrong on this, I suspect depending on how earnings start to play themselves out, that we could actually see valuations turn negative if our expectations of earnings don't bounce like many analysts expect that they might bounce off of the bottom. Is that a fair statement?
Absolutely, and certainly we've seen some of the financial companies report in the last several days, and they are probably worse than people expected. Obviously one sector, but it will all come back to when does the economy turn on again and how will we recover and how quickly?
Sure. And then market sentiment. Now, market sentiment didn't turn completely red in the first quarter, although we do project that it will be going red and may have already gone red. I mean, we're starting to see some of the economic and sentiment data released because we pulled this information together so quickly after the quarter end. We frankly didn't have all of the data points that we normally do, which is why we typically wait an extra week or so for some of these data points to come in to update this before the webinar. But we expect market sentiment will turn into the red if it may not have already done so here in April. So overall, taking those four factors, economy, credit markets, valuations, and market sentiment, the composite, as we look at the dashboard, has turned red. So it went from more neutral to red. And I should also note, as we're looking at the projected numbers, that's a major change as well from the data that we had released just, again, a couple of months ago as we looked at the close of the year. How does this look on our chart as we chart out the dashboard over the past many years? Well, it's pretty clear that everything moved down significantly from where we were in December, which from a composite standpoint wasn't necessarily strongly in the positive area, but nonetheless wasn't so negative as we're seeing today. Anything else you want to add to that, Jonathan?
Yeah, so the orange line is the 6 month, you can see, is only a little bit below the red line. But obviously that's trailing data, and we should see that come down as well. And when we look at the actual dashboard composite, it's now approaching levels that we saw in prior downturns.
So, and that's a good point. So the 6 month average, we would expect to continue to come down, while if we do get the economy back up and running, the actual dashboard composite number will probably bounce off the bottom. So here's a unusual period where we actually have the dashboard composite potentially improving while the 6 month trailing average is going to continue to deteriorate. All right. So with that, then let's look at our scorecard. And here, as we saw with the dashboard, we had a lot of adjustments from either the positive or neutral categories shift over into the negative category. So employment, it has the negative next to it, indicating that that was a category downgrade. And actually that one got downgraded from positive to negative. And there were several others, all related to COVID-19, that have been downgraded. Consumer confidence, credit conditions, global growth, etc. I mean, these all are part of the COVID-19 story. And then, of course, Eurozone, China, and tariffs, as well as geopolitics, round out the negative category. Is there any one there, Jonathan, that you want to touch on right now?
Yes, when we were putting the slides together, we didn't have a lot of actual economic numbers out. That changed this morning. We saw retail sales came out. They came in down 8.7% for March. Probably not that much of a surprise. On a detail basis, we saw online growth of 3.1%. Grocery stores had a big increase, and then obviously traditional department stores saw a big decline. And then the other major data point that came out today was U.S. manufacturing, which was down 6.3% in March, its biggest drop since 1946.
Wow. All right, so not great news, but honestly should not be that terrible of a surprise either, considering that the economy is essentially shut down. On the neutral side, we have housing, the corporate sector, U.S. politics. Now, touch on the U.S. politics, because you have an up arrow here. Why do we think U.S. politics maybe have shifted in sentiment more positively?
Well, I think of it as kind of bipartisanship. Chris will talk about the CARES Act, but there's been a lot of stimulus put in place through basically the fiscal stimulus programs. Maybe they didn't really love each other in doing it, but they did come together and they did pass it in relatively record time. And we have another slide later where we'll show that timeline.
Well, and the other thing we have to keep in mind is that it is an election year. And so that up arrow could change to a down arrow in the matter of days or weeks. So I think, we've lost kind of track that November is the election, and there's going to be a lot of jockeying between now and then when it comes to the two parties. Of course, then in neutral, we also have the US dollar and US inflation, which is remaining in check. And then on the positive, as you just noted, Jonathan, the fiscal policy has definitely been a positive. The two parties have come together and have passed the CARES Act, and we would expect, frankly, they're working on another set of fiscal relief or stimulus, depending on how you want to refer to it as. We're also going to touch on monetary policy, because the Federal Reserve has done a lot in the course of the past 3 or 4 weeks. So that's been very, very positive. Interest rates are still positive. They remain in check. 30-year mortgages, things of that nature are still very accommodative, although the housing industry, for other reasons, is going through a bit of a struggle. And commodity prices, and actually, Jonathan, you and I touched on this morning. You want to share with the audience the information you had provided me this morning on commodity prices?
Right. So obviously, when you look at metals prices and things like that are inputs to other industries, the fact that they've come down, that's very good. However, the U.S. now exports oil. And so the drop in oil prices we've seen in the last couple months is pretty staggering. And this morning, oil inventory data for the last week came out, and they increased by 19 million barrels a day. And that is incredible, just how much demand destruction there's been in the last month. And when you look at the OPEC deal that just was announced, that was a cut of 10 million barrels a day. And so we'll show a slide later, but the oil markets, even with that cut, are still going to build inventories. And that obviously is good for U.S. Oil producers.
Right, right. So let's take just a quick glimpse of what COVID-19 has done to consumer spending. And here you've provided us a chart of the spending on U.S. hotels, which has plummeted. It's that red line that's going down to about 35% of occupancy. And you've given us another chart here on seated diners, which has also plummeted with all of these restaurants being shut down, at least for seated services, although some of them are still operating for takeout. And here we see the spending trends by category. So again, a lot of the hospitality areas hit just very, very dramatically, while, as you noted, grocery being kind of one of the sole areas of some relief. All right, so how has that demand then impacted jobless claims? Could you walk us through this, Jonathan?
Sure. On this slide, we're showing in green those vertical lines. Those are U.S. recessionary periods. Then we're looking at the 4-week average initial jobless claims, and then we show basically a 60-month average. And what we're going to see is you can see those peaks in prior recessions. And when you look at the peak right at the end, that's the last couple of weeks. Now, obviously, when we look at actual numbers, they're around 6 million or a little more in the last week. So this is unprecedented. We've never seen it this quickly, and just the sheer number of people taking initial jobless claims, adding to these numbers.
Yeah, and I think what you had said is super important, that this is the blue line's the 4-week jobless claims, but if you look week by week, I think they jumped the first week of kind of the shutdown, they had jumped to 3.3 million, somewhere in that neighborhood, which was multiple times worse than any other period, a 1-week period on record. And the very next week, it went from 3.3 to like 6.6 million. I mean, really, if you didn't actually know what was happening, you might not actually believe the numbers. And here's the potential. And the potential is even worse.
Right. So here we're showing, essentially the consumer side of the economy. So, the worst case scenario is there could be 9 million jobs lost in restaurants, more than 3 million in education, and so forth. And in fact, when you put all these numbers together, it could be as much as 35 million. And that's not even counting other industries that might be impacted as well.
So if we have a drop in demand with all the stay-at-home orders, obviously a spike in unemployment, it's going to have an impact ultimately on GDP. And so here we've provided some estimates of the quarterly and annual GDP from Goldman, Bank of America, Morgan Stanley, JP Morgan, etc. And the one thing I will say is this data is all as of the end of March. I know for certain several of these firms have actually lowered their estimates since the end of March. So for example, if we look at JP Morgan, which is around that middle column, their second quarter estimate at that time was GDP would be down 14% in that second quarter, up 8% in the third quarter, up 4% in the fourth quarter. having an annual GDP of around negative 1.8 or so. I just in the last couple of days have heard from some folks at JP Morgan that they've lowered that. And I think they're projecting maybe closer into the mid 20s or even 30% loss of GDP in the second quarter. So most of these numbers are probably going to be revised down from where they are. Now, the other thing I'll point out, though, is those that have the biggest decline in the second quarter tend to have the biggest jump in the third quarter. And that's been pretty consistent, that those who believe it's going to get really, really bad also still believe that there's going to be a nice bounce off the bottom. And whether that bounce actually happens in the third quarter or fourth quarter, or maybe even first quarter of next year, I think that's being debated. And frankly, I think that's also being pushed out a little bit further. So maybe the bounce isn't coming in the third quarter like alluded to here. Maybe it might be a fourth quarter or first quarter 2021 bounce. Anything we should add there, Jonathan, with regards to the estimates? And are you seeing the same downgrades and estimates as what I'm seeing?
Yeah, absolutely. I think Goldman has kind of changed their numbers around as well. I think the other thing to add is if we look kind of on that 2020 average, down 1.6%. Kind of the worst case is negative 3%. It's hard to know. It could be a little bit worse than that. But when you see such big losses in the second quarter, we have to remember that's one quarter, not the year necessarily.
Yeah, and that's a fair point. Although I do think that these one-year numbers are probably going to be ratcheted down a little bit, which let's put that in terms of history. So let's just say, excuse me, we're down 3% for the year in GDP. Well, if we look here at this next slide, sorry about that. I'm gonna get our slides going here. There we go. If we look in terms of history, if we're down 3%, we had a contraction in 2009, not quite to the 3% range though, but somewhat comparable. We really have to go all the way back into the 30s to find anything worse or comparable. Now, if we end up in that 5% down range, that clearly we would have to look back into the late 30s, which is obviously Great Depression era type figures. Now, the big difference here, and we haven't mentioned it, we've alluded to it, but we haven't mentioned it, and that is this is a self-induced shutdown, self-induced recession. We've never had this kind of a recession where it's been self-induced. And I think that's why a lot of analysts believe that the economy will bounce back rather quickly. It'll take a little time to get up and running, but the GDP numbers are not going to stay -3, -5, or on a quarterly basis, -20 or 30% consistently like we saw during the Great Depression. That's just, nobody's expecting that to be the case. So that's a glimmer of hope as we look out into the future. Now, of course, this is also going to have an impact on earnings, not just GDP, but on earnings. And earnings are expected to contract. And as you'll see from the far right side of this slide, new forecasts have earnings going into the negative. Now we're early into the earnings season, just been a couple of days, but in rare cases are we seeing earnings come in better than expected. There's a few companies, I think United Health announced this morning, and they were right on target. And actually, I think they reaffirmed their full year target as well. But that is an exception to what we've seen or what we expect to see. Jonathan, do you want to add anything there?
Yeah, and this will be a moving target because typically analysts tend to start optimistic and then they turn a little bit more pessimistic. And they really honestly need to hear from the companies to make their projections. So I'd expect these to come down from here.
Well, the other thing I'm keeping in mind is right now, I mean, this earnings season today and over the next couple of weeks, frankly, I don't even know if it means anything. I mean, all of the economic data we've looked at thus far is terrible. I mean, there's no way to explain it otherwise. It's just ugly. And it's going to get uglier. I mean, we know that economic data is going to be super bad. And again, it's because of the self-induced shutdown. So these earnings, I just don't know how reliable or how important they are anyway. And I think we need to get into the next quarter of earnings season and see how things start to recover. That's really, I think, in my opinion, going to make the difference.
Totally agree.
So we alluded to the monetary policy that has occurred over the last couple of weeks, and the fact that the Federal Reserve is really all in. I mean, they are absolutely on top of this issue, and they've instituted so much in just a short period of time that I think I mentioned it even later. It's hard to fight the Fed. I mean, I think the last week or two where we've seen the market really bounce off the bottom is because of the reaction that we've seen both on the fiscal and here on the monetary policy. As an example, at the end of February, Jerome Powell, the head of the Federal Reserve, came out and he made a statement. And he basically said the fundamentals of the US economy remain strong. However, the coronavirus poses evolving risks to the economic activity. So at the end of February, even the head of the Federal Reserve was not foreseeing what we were about to experience in March. But they are quick learners. And by March 15th, the Fed cut interest rates to 0 to 0.25% target. On the 17th, they established the primary dealer credit facility and the commercial paper funding facility, both programs that had been instituted during the Great Recession, but here they're instituting these programs with bigger dollars and much more quickly after the start of the crisis. The 18th, they instituted a money market mutual fund liquidity program, again, something they reconstituted from the Great Recession. From the 19th through the 31st, there were additional extensive measures announced to support the economy by the Federal Reserve. The 31st, they established a temporary repo facility. Going into then April, they adjusted leverage ratios with banks. They were working with mortgage servicers on giving homeowners a little bit of relief on their mortgage payments. And then comes April 6th, where they announced the PPP, the Payroll Protection Program, where literally the Federal Reserve is now lending money to small businesses. A lot of folks in the audience may not have an appreciation for what happened on April 6th, but this is really historic. The Federal Reserve had never before acted as a lender of last resort to businesses until here. And this changes the whole game going forward. And then on the 7th through the 8th, there were different statements on loan modifications and growth restrictions lifted on Wells Fargo, et cetera, et cetera. I mean, the list just keeps going. And on the 9th, they announced an additional 2.3 trillion in loans. So when I say the Federal Reserve is all in, they really are all in. Neil Kashkari even mentioned on 60 Minutes, the amount of money that they're willing to throw at this issue is limitless. There is no limit to how much they're willing to throw at keeping the economy in check. So we're talking about trillions of dollars going into the banking system, unlimited quantitative easing, and again, the Federal Reserve acting as a lender of last resort, not just to banks, but now to companies. This is the beginning of a new era, in my opinion. Uh, I don't think the average American has an appreciation for the magnitude of what has occurred over the last couple of weeks. And unfortunately, at some point, I think we're going to have to deal with the consequences of this, both from a deficit perspective and from just a moral hazard perspective. I mean, we've heard nobody talk about moral hazard, and that's probably okay. It's probably legitimate that we're not asking those questions today because we are in the middle of a crisis, but we will need to start asking these questions over the next couple of quarters and hopefully in the next year or two. But that's for a future webinar discussion, not for today. So Jonathan, show us here though. I'm sorry, my slides are not working as I wish them to work. See if I can get to the slide. It's not going to get me to the slide that I want. Well, instead of seeing the slide, let's just talk through this slide, Jonathan, that basically shows how Congress has acted so quickly from a fiscal policy. We just looked at the monetary policy, but from a fiscal policy, talk us through this next slide that I unfortunately am not going to be able to pull up here on the webinar.
So basically, we talked about bipartisanship and how quickly Congress acted in passing the CARES Act. Essentially together with the two other measures, it's about 2.3 trillion. And again, there might be more coming, but they enacted all of this within 100 days of the first death from the coronavirus. Whereas when you look back to the financial crisis and the Great Recession, these type of measures didn't even start until almost day 200. And so, and that kind of built. So we're kind of in this first stage above the level that was spent at that point. And that took a couple years in total to enact everything. So again, the magnitude is very large, and it was very, very quickly passed.
Yeah, and I think that's really the point. Monetary policy has been super accommodative, well past anything done historically. Fiscal policy equally as accommodative. Twice, if not three times as fast, with more money thrown at this issue than even in the Great Recession. So with that, and I apologize for not being able to see that slide, it will be part of the webinar materials posted to the SilverOak website, but for whatever reason, we had some technical difficulties there and could not pull it up. But with that having been said, let's transition into the markets. And just like with the economy, where COVID-19 said it all, it pretty much says it all when we talk about the markets for the quarter. As we look ahead here, we can see everything for the quarter as it relates to equity markets, negative double digit. Should not be a surprise to anybody. And really, all of this performance came in the last 3 weeks. That was so pronounced that even if we go back into 2019, the one-year trailing numbers are still negative. Now, the only bright spot that we did see is bonds. At least the overall Barclays aggregate was up for the quarter. Global bonds were down, as were commodities and REITs, or real estate investment trust. And again, for the year, the bright spot being bonds. So when we talk about bonds, and bonds being the ballast or the safety component, the more conservative component of the portfolio, this is what we're talking about, that in big drawdowns, bonds usually do relatively well. We're not going to get into the details today, but there was a week or two period of time where actually most bonds outside of treasuries were negative. And that was because the credit markets essentially froze up. But again, with the Federal Reserve stepping in, those markets started behaving a bit more typical of what we would expect. So here we see equity market conditions. First quarter, it's pretty clear that growth stocks outperformed and large cap outperformed. So as we're looking at the first quarter box, that top right quadrant. In the 1 year, pretty much the same story. That top right quadrant, the large cap and the growth oriented stocks performing better than, say, small cap and value oriented stocks. And you can explain on this slide why that might be the case, Jonathan.
So here we're showing the losses in Q1. In the middle, we have the S&P, and then we have the growth-oriented sectors on the bottom half, and then value on the top. So one of the things you can kind of see is if we look at the top and we see financials and energy, you know, those are down 30 to 50%. You know, so those kind of stand out. And then when you look at growth, you're going to see, you know, essentially down, but technology is certainly down the least. And the reason that's important is when you look at the percentage of technology within the growth space, it's an outsized level. So when we look at healthcare and technology together, it's almost 50% of the growth category. Whereas when we look at energy, yeah, it's down 50%. It's not down as much, but the real issue is that financials are down more than 30%, and they make up almost a third of the value category. And so if you advance the next click, we'll then see kind of what it looks like on a 1 year basis. And here you can, you know, truly see the difference. So technology, in fact, is nicely positive still, as well as healthcare. But you can see the biggest component for value is financials, and they're down on a 1 year basis.
Sure. So growth got the benefit of technology, which is a big component. Financials, unfortunately, make up a big component of value, and they just simply have not done as well.
Right. So consumer staples and utilities, while up, they're just not a big part of the overall weighting.
Sure. Okay. Now there was a flight to safety. We kind of alluded to that, but before we get there, I guess we're going to look at the international returns, and of course, international is not a flight to safety. International is maybe considered a little bit more risky than the U.S., given it's got geopolitical and currency risk associated with it. What are some of the interesting components of this chart, Jonathan?
Well, Latin America is down the most, and that's really because of Brazil being the biggest part of that weighting, and they have a very large energy component. So Petrobras being one of the largest companies within that index. So that really kind of explains that. If you look to the far right, you can see really the European countries. They're kind of all within line. And I think the other thing that just really stands out is China not being down much, despite their really being the original epicenter of COVID-19.
Sure. And here is the flight to safety. So here's where we're going to see, both for the quarter and for the year, Treasury bonds outperforming all of the other various types of bonds, with those that are riskiest in the bond world over on the left actually in negative territory.
Absolutely. And so we're going to show in a couple slides, but essentially, while interest rates went down, helping Treasury bonds, the spread between Treasury bonds and other type of bonds like corporate bonds and such, those spreads widened due to the perceived extra risk.
And I think that's right here on this next slide where we'll see those spreads. If we're looking at either the blue or the red, it doesn't matter. One's corporate, one's high yield. When the line spikes up, that's a wider spread, meaning greater risk, more fear in the markets, correct?
Right. So basically, those bond prices went down, essentially. And essentially, you needed a higher interest rate to pay for the risk you're taking.
And we're seeing here these spikes at the far right, again, whether we're looking at corporates or high yield, exceed the spikes that we saw during the Great Recession. So a lot of people have been comparing what we're going through to the Great Recession, but on a number of levels, this is actually even worse than the Great Recession.
Right, and that's one of the reasons why the Fed stepped in. And one of the things you didn't mention before, but is an interesting thing about the Fed being all in, is that they are now buying corporate bonds and in some cases high yield bonds.
I'm glad you mentioned that. Yeah, because that was a major shift too. And also municipal bonds. So corporate municipals and some high yield they're looking at purchasing. And I had heard some analysts estimate that they actually might be buying up to 25, maybe even more % of the high yield market right now, which is pretty staggering.
Right, I guess it's not just too big to fail, but nobody fails.
Yeah, right, which gets to the moral hazard, which again, probably isn't an appropriate discussion for today or even a question for today, but it will be a question that we'll want to address over the next couple of quarters. And here what we're seeing are the municipal bond spreads. So, we always think of municipal bonds as being safe, at least the type of municipal bonds that we're buying. But we saw those spreads widen, as with the others, even beyond what we saw in the Great Recession.
And one of the Fed programs is they're going to direct lend to municipalities. So we have seen municipal spreads start to come down.
Yeah, and you can't really see it here, but you're right, it is starting to drop. So this slide, there we go. This slide is with regards to what you had alluded to earlier on commodities with oil.
Right. So the blue bars are basically showing the buildup in inventories that have been occurring, and it's projected to continue to grow. That's kind of what you see on the far right. And again, as I mentioned, even with the OPEC cut, it's not likely in the short term enough to make up for the loss in demand that we've seen.
Yeah, and this would be a story in and of itself if we didn't have all the other consequences of COVID-19. Frankly, as would the election. The election is a story in and of itself, but people have kind of forgotten about that as a result of everything else resulting from COVID-19. So with that, we've talked a lot about what has not been so good. But there is some good news. And the good news is that since March 23rd, which was kind of the bottom of the market, through April 9th, there was a nice bounce that occurred. And you're going to see pretty much across the board, whether it was in bonds or large cap US, mid cap, small cap international, there has been a nice bounce off the bottom. Doesn't mean to say we can't test the bottom again, but at least it wasn't straight down all the way without any hope that things were going to recover. And I honestly think psychologically that's done a lot for investors over the last week or two. So let's quickly transition over into past pandemics and making history, because I know we're going to be cutting short a little bit on time, and I want to make sure Chris has enough time to go through the CARES Act, and some of the slides here are super interesting. So first, with past pandemics, we're going to see that if you believed anybody could have predicted the impact that the coronavirus is having based on past pandemics, you're just simply wrong. I mean, if we look here, we can clearly see, going back all the way into the 80s, that prior pandemics have not been correlated with market pullbacks, really of any magnitude, let alone recessionary level type pullbacks. And whether that was measles, Zika, Ebola, I mean, none of these have that level of correlation. So I think it's very hard to point the finger at any one person to say, well, you should have known, and therefore you should have done this or done that, because pandemics just historically have not had this kind of an impact. But this one has been very impactful. As a matter of fact, it's been the fastest bull to bear in history. In 16 days, we went from being in a bull market to a bear market. And you can obviously see from the chart that it's not even close to how quickly we've done that transition in the past. So we are making history here. We're making history as we look at worst days in the market. So this is going back to 1950. In March, we had 3 of the worst days in the market, going back all the way into the 50s. We also had multiple circuit breakers hit during March. That had only happened once since circuit breakers were introduced in 1987. But we had multiple days in March where circuit breakers were hit and the stock market was shut down temporarily for 15 minutes. Now, having said that, we also saw some of the best days with regards to the markets. We didn't put them here on the chart, but we did have on March 24th, the Dow Jones Industrial up 11%. That was the best day since 1987. In April 6th, the week of April 6th, that was the best week in the market since 1974. So as we've alluded to in prior webinars, including in our April 2019 webinar, volatility tends to bunch. And that's the challenge with market timing. Yeah, you might miss the worst day, but you're probably going to miss one of the best days too, because they tend to bunch. The other interesting statistic as we're making history is, as of April 6th, there were 28 consecutive days of the markets moving up or down at least 0.5%. So moving up and down at least 0.5%. That had not occurred since 1931. 1931 we have to go back to look at a comparable. And even in 1931, it only happened 33 consecutive days. So not that many more than what we had hit in March. Of course, we also saw March being one of the worst months on record, going back to the 1950s. And the quarter being one of the worst quarters. So we have worst days, worst weeks, worst months, and worst quarters. Okay. One thing I did skip through, and I'm going to just touch on it here, but when you get the slides, you can certainly spend a little bit more time looking at. It's the 1-year return after the big decline. So as we look down, as we're looking at, let's say, November of 2008, the S&P was down 29%. 1 year later, it was actually up 25%. Or in 1987, it was down another 29%. But 1 year later, it was up 23%. So here's some hope, a little glimmer of hope. When we have big drawdowns, it's not unusual for 1 year later to have the market do really, really well, to have that bounce off the bottom. Whether that's going to happen this time is uncertain. There are no guarantees. But if we look back in history, it is relatively consistent that we have strong performance 1 year after these big drawdowns. And the only thing we wanted to point out here was small cap stocks or little companies got hit harder than the bigger companies. So actually small caps, they made history being the worst 2-week decline really on record. and the worst 1-month decline on record. So we've got large caps that have hit historic downturns, but small caps even more so. Now, where do we go from here? This chart's showing us the performance over the last couple of years, and we can see the sharp decline in the chart. And where that decline is going is actually not to shallow recessions, but we've already hit the decline that we normally see in average recessions, down 30+%. Now, if this recession turns into a deep recession, like 2007, we could have further to go. We might not have seen the bottom. We don't believe that to be the case, at least not the base case, because this is a self-induced shutdown and a self-induced likely recession. And we think the startup's going to be much quicker than in other recessions. But just to give perspective, it could get worse if this turns into a deep recession. So what will this one look like? Well, first of all, we don't know for sure we're in a recession. I keep mentioning that we are, but I guess technically it hasn't been called a recession yet, but we likely are in it. We don't know exactly when it started. We don't know exactly when it's going to end. But if we look back at history, we do know when the S&P 500 is down, and I'm looking at the third column from the left here, when the S&P 500 is down at least 30%, many times it's got further to go down. And you'll see that in the fifth column from the left, the further decline to the bottom. So if we look at like 1968, S&P change was down 36%, but it still had 8% to go to the bottom. Now, again, the hope is 1 year forward, a lot of these numbers are positive. 3 years forward, they're all positive. 5 years forward, they're all not just positive, but they're very, very strong. And 10 years forward, all positive. So again, the shining light is don't get stuck on today, but think about tomorrow, or in this case, think 12 months, 24 months, 36 months into the future. So what's our outlook? Well, we're going to go through this again relatively quickly, but it all comes down to COVID-19. How is it progressing, and what are the therapeutic treatments that we have, antiviral and vaccines, things of that nature, to fight the progression? That is going to be key for the economy and, frankly, for the markets as well. And that's going to probably dictate, is this a V-shape or a U-shape or an L-shaped recovery? But we are making history because we are in the midst of this self-induced recession. Don't fight the Fed. I mean, from a fundamental perspective, when we see the economic data, it's going to be so ugly, it's going to be hard to comprehend. But understand, monetary and fiscal policy is fighting all of that current economic data to try and keep the economy on a stable platform to come out of this as we get to the other side. Okay. Internationally, pretty much the same thing. COVID-19 is going to dictate how the international economies come out of this. The good news is Europe's probably 4, maybe 6 weeks ahead of us. And China actually appears to be recovering. So that's positive. We can hope that we'll also recover here shortly as well. But don't forget the monumental impact that is not only happening in the US, but also overseas. Maybe not as big overseas as what we're seeing in the US, but nonetheless, significant stimulus. So with equities, despite the recent recovery, we probably are still in a bear market. And Jonathan, I think you can attest, we put these slides together several days ago. So this wasn't as a result of today's market, which looks to be kind of trending to the negative side after the economic data came out this morning. We expected the markets probably to pull back. Nobody knows for sure when people start seeing how bad the economic data really is going to get. Okay, earnings are going to get impacted, but honestly, I don't think earnings mean that much this quarter. Maybe not that much next quarter, but as we move forward, they will. Volatility is going to remain. Don't forget it's an election year. And with this wide dispersion of potential outcomes, depending on all of the impact that the COVID virus is going to have, diversification couldn't be more important. Absolutely could not be more important. With bonds, we have all this unprecedented money going into the systems, so don't fight the Fed. Treasury yields, they're likely in a trading range. Okay, but bonds still provide the protection, at least the high quality bonds. I wouldn't be treading into high yield or junk bonds. That, there are some opportunities there for sure. For certain individuals that can take the risk, there may be some great opportunities, but for most investors, you just need to stay away from those types of bonds. Focus on quality. Jonathan, I know I went through those relatively quickly. Anything you would like to add that we didn't touch on?
No, I think you covered it very well.
Okay. So there are brighter days. Believe it or not, they're on their way. Don't focus on the market bottom. I tell everybody, focus on the bottom half of the trough. You don't have to time the bottom. And this chart is really speaking to that. The average one-year return for all periods is 8.9%. If you were kind of late to come to the game and put money to work, and this is for clients who maybe have a little bit of cash on the sidelines, well, even if you're late to the game, you still have pretty good returns. Even if you were early, you have good returns. Now, yeah, if you could time the bottom and have that perfect bear market timing, sure, you could do better than all of these other scenarios. But the goal here is not to try and time the bottom because it's impossible. It's putting money to work around the bottom of the trough. So don't be scared. And I know the last week or two, a lot of clients have reached out and said, hey, we're ready to put to work some of the cash that we had on the sidelines. And that's great. We're probably still in the bottom half of the trough. But that perspective changed a lot from 2 weeks prior, where nobody really wanted to put much money to work when we rarely were at the bottoms of the market. So, or at least the bottoms that we've seen thus far. And know that bears always get beat by bulls. Bears always get beat by bulls. What do I mean by that? Bear markets are usually short and shallow. Bulls are usually long and tall. So bear markets get beat by bulls, or the way I put it here, I guess, bulls beat bears. Bears are short and shallow, bulls long and tall. And here we say, don't be the average investor. Seriously, this is probably one of the biggest frustrations as advisors. If you bought the S&P 500 and held it from 1999 to 2019, you'd earn 6%. If you were in a 60-40 mix between stocks and bonds, you'd earn almost that much over that entire time frame. But the average investor, much lower, much, much lower. And maybe my favorite chart of all, and I know we're coming up on the end, and Chris, we're still going to go through your presentation. We're just going to go a little bit over, so those participants that can stay a little bit longer, I welcome you to do so. But before we do that, this is one of my favorite charts that I've seen. I think BlackRock put this together. If you were invested in a diversified portfolio from 2000 to 2002, you would have earned negative 18%. as an investor, what's your reaction? I lost money. Even though you lost less than the S&P 500, the typical reaction is, I don't care, I still lost money. Then from 2003 to 2007, you would have gained 73%, but that was less than the S&P 500. So what would have you said? Well, I didn't make as much. I should have been in the S&P 500 because I didn't make as much in my diversified portfolio. And then in 2008, what happens? Well, you're down 24%. That's less than the 37 that the S&P was down. But again, normal investor psychology is, I still lost money. I'm not happy because I lost money. And then from 2009 to 2019, you made money again, 191%. But that was a little bit more than half, or right about half of the S&P. So what do you say as an investor? Probably, well, dang, I didn't make as much. So I'm not very happy because I didn't make as much. And then in 2020, again, down, not down as much, but I still lost money. So in each of those periods, you probably didn't feel all that good, either because you didn't make as much or you lost money. Yet, in the end, diversification won. In the end, diversification won. So the point of this is it may not always feel good to be diversified, but in the end, being diversified and having diversified portfolios, they win. So with that, let's go into the CARES Act. And Chris, my apologies for running a little long on this. I don't want you to rush through this because I think there are certain areas that our audience is going to want to hear about. So can you tell us just big picture what the major individual tax related provisions of the CARES Act are?
Yeah, absolutely, Shannon. So similar to what we were talking about before, most of these provisions are designed to get money in taxpayers' pockets. So kind of the one that most people have heard about are the individual recovery rebates and credits. We'll talk a little bit more about that here in a second. Because there's been such a drop in the markets, similar to 2009, they've stepped in and waived the required minimum distributions for 2020. They've eliminated the 10% early withdrawal penalties for the folks under 59 and a half, providing they qualify. They've added a front page $300 charitable deduction. They've given taxpayers who have the wherewithal to do so to give a little bit more during this time by getting rid of the charitable contribution limit in 2020. They've kind of helped with students a couple different ways. Number one, they've allowed employers who basically are willing to pay some student loan debt, they've given that some tax-free status. And then they've also kind of bumped out until September, no payments or no interest until September on student loans. And then finally, as you mentioned before, there's been some incentives from a business standpoint as well. One of the ways is really, when the Secure Act passed a couple years ago, they really put limitations on how much of a loss could be deducted in a given year. What we've found here is because they recognize that there's probably not going to be a great year in 2020, they've kind of rolled back some of those provisions. So although these provisions didn't go away, what they've said is we're going to do a do-over, give you some opportunity to go back and maybe take advantage of some of the losses you might not have been able to use previously, and then we'll pick up with this stuff starting in 2021.
Okay.
So why don't we go to the next slide, Jen? Okay, go ahead, Jen.
Yeah. I was going to say this individual rebate and credit. I think a lot of folks, even if they don't qualify for it, are interested in hearing about it.
Yep, and this is something that's been talked about probably more than anything in this provision or this bill is really the individual stimulus payments. And again, they're designed to get money into folks' pockets, and maybe when they aren't earning as much, they have at least a little bit of cash flow. So it's $1,200 per person. Married couples is $2,400. For dependent, if you have dependents under the age of 17, there's an additional $500 per dependent. Now most taxpayers are eligible. However, there are some rules that we need to be aware of. Number one, you have to have a Social Security number to be able to qualify for this. Can't be non-resident aliens. You can't be a dependent of another taxpayer. So that means the college students and anybody that's kind of in that 17 and above age group that's a dependent, they're not going to qualify. And then finally, estates and trusts are not eligible for this. There is a phase out.
Not to interrupt, but the one thing I was going to mention is they are talking about passing another bill, and that new bill might actually include, say, the college student to be able to get this $500, because I think there's a lot of pushback as to why college students who may be dependents but maybe lost their summer jobs, why they can't get some kind of relief as well.
Absolutely, certainly, both having college-age students, I know at our household there's a little bit of anxiety about that. So from as far as these credits go, they do phase out though. At income above certain levels, they start to phase out. We've got on the chart here. If you're single or married filing separate, that's at $75,000. Head of household, that's at $112,500. And married filing joint is $150,000. Now keep in mind, that's where they start to phase out. So even with income above those levels, you're still going to get something. So just as a example, if you had a husband and wife that were married filing joint, they wouldn't fully, and no children, they wouldn't fully phase out until $198,000 of adjusted gross income. If they had 2 children, it would be at $218,000 of adjusted gross income. So I think there's at least a little bit of misconception that folks aren't going to get it with income levels above the phase out, but they will get something.
Good point.
The other thing is the no required minimum distributions for 2020. So it really applies to anyone who's required to take an RMD in 2020. This is going to include anybody that had to take RMDs as a result of inherited IRAs, and taxpayers who have already taken their RMDs for the year. Similar to the IRA rollover rules, they're going to have 60 days to be able to put that back into the plan as it stands now. This doesn't include, however, those folks that took RMDs from inherited IRAs. If you were someone that was subject to a 5-year distribution rule under an IRA that you had inherited, where it all had to come out in 5 years, it just doesn't count. 2020 doesn't count. That money would come out over 6 years under that scenario there.
Okay. And again, I think this is an area where we may see more legislation where the 60-day rollback rule might actually just say, hey, if you took it out at any point during the year and you want to put it back into the IRA, you can do so. That's not current legislation, but there is discussion that that's maybe new legislation coming out. Is that correct?
Yeah, and as part of this, I kind of looked back at what happened in 2009 when, something similar happened. Quite honestly, the waiver of RMD rules looks very similar. That language looks very similar. And in that case, they actually ended up coming up after the fact with a rule that, kind of gave folks up until November 30th of the year to put, to basically act on that. So as you indicated, there could be some options later down the road.
Okay.
As I indicated before, the 10% early distribution penalty is waived. That really just applies to folks who are under 59 and a half, need access to funds in their 401k. It's limited to 100,000. One of the benefits is that they can make an election to pay tax on it over 3 years, and then they actually have the option in this case to put it back over 3 years. Now the key here is you must meet the requirements to qualify, which is a longer list. The other thing to just make note of is for those folks who don't necessarily want to take a distribution from the retirement plan, they've also increased the plan loan limits on that up to $100,000. So that is a nice provision if folks don't want to take that money out.
In the old provision, what was it, 50,000?
Correct. Yep.
Yep.
Or I think it was 50% of the cash balance. So
Right.
So it's a combo limit.
All right.
So as we indicated, there's a lot of other non-tax related provisions. So the expansion of unemployment, that was really an expansion from eligibility as far as who qualifies, an additional amount per week. So the federal government stepped in and increased the weekly amount by $600 a week. And then they also extended the period for which you can claim unemployment an additional 13 weeks. In order to, the next two, the employer retention credit and the paycheck protection program loans are really, I think, goes back to our slide when we think about, how unemployment has changed throughout this. These are really incentives to get employers to, keep people on the payroll and pay them during this period. So for employees or businesses with 100 or less employees, they have an opportunity to claim a credit of 50% of wages for the period, brief period of time. And then the paycheck protection programs that we talked about, where through banks, employers with less than 500 employees can actually go to the bank, apply for loans that will cover payroll. There's some utilities and rent included in that as well. And there is a portion of this that can be forgiven, up to 75% of that, provided it's spent on qualifying items. And then finally, another provision that was added to help employers was really to give them the opportunity to wait to pay their portion of payroll taxes. So they've actually deferred it out for a couple years. So they could take their 50% of the portion could be deferred until 12/30/21. The balance could be deferred until 12/31/22. One thing to note in here is this also applies to self-employment folks as well. So if you're someone who on your individual return, has to pay some self-employment taxes, there could be a deferral. How that works, I don't think we really know all that yet, and we're going to need to wait for some additional details, but that opportunity is there for folks that need it.
Sure. And maybe the one thing that is impacting almost everybody are the tax deadlines, because those have changed dramatically here over the last couple of weeks. So could you walk us through the major changes there?
Yeah, absolutely. So it's, today is not your typical tax day because it's not a tax day at all. The federal individual, trust, and gift tax return deadline would normally be due today, but that's automatically been extended out until July 15th. And that includes any balances due. So any taxpayers that, finished their taxes and owe money, they don't have to remit the payments today. They actually have up until July with no interest or penalties to make that. And then just recently, probably in the last week, the IRS further came out and said that this applies not only to the first quarter estimates, which the original announcement did, but also to second quarter federal tax estimates for 2020. So any payments that are due between April 15th and July 15th will actually just have an extended due date of July 15th. Once we get to the states, it varies a little bit. Most states have actually come on board and also extended till the due date of the filing returns until July 15th. But as we see in the next bullet point is that doesn't necessarily apply to estimates. A lot of states have also extended at least the first quarter estimates to July 15th, but some states, Minnesota being one of them, has basically not done that. They've still continued to ask taxpayers to make a April 15th payment for estimated tax purposes. Now they've just over the weekend, they instituted another rule that said if you pay in at least 75% of your 2018 liability, assuming that's a lower amount. They've just added some additional provisions to give you options to pay in less. Nonetheless, they've asked you to make the payment. One thing to note, though, Minnesota did not extend the due date for trust returns, so those are still due today. And then finally, a couple pieces that go along with the normal tax filing date is the IRA and HSA contribution. So taxpayers are allowed to make the previous year, the 2019 contribution by the due date. That too has been bumped out to July 15th, given the extension of the deadlines.
Good. Well, and I think, it is a little confusing, especially since Minnesota did not extend their first quarter payments, because over the last week or two, or even just the last day or two, we've been in communication with a lot of our clients coordinating first quarter payments, and their 2019 returns aren't even done. I mean, that would typically be unheard of, but that's the reason, is that the 19 returns have all been extended, but unfortunately Minnesota did not extend first quarter payments. So we kind of are working a little bit backwards than normal, but nonetheless, I think we've got everybody taken care of. So thank you, Chris, for
the other thing I'd just add is, if for anybody who wants to go a little bit deeper into this, just note that we did put out a white pages on the CARES Act. So some of the stuff we talked about today, there's just a little more verbiage about that in that document.
Oh, good point. And that can be found out on the SilverOak website. So if you go out to our website, we do have the white paper posted. And with that, I encourage everyone to contact your SilverOak advisor if you do have any questions and or topics for our next webinar. I'm sure there's going to be lots to discuss between now and then. If you are not working with an advisor and you have questions, you certainly can reach out to me. Again, my contact information is shown here. It's 952-896-5701. My apologies for going a little bit over in today's webinar, but we did have a lot of information to cover since so much has happened in just the last couple of weeks. But with that, thank you for attending, and have a great afternoon.